What are the different types of internal controls we have? Number one is the preventive control. What is a preventive control? Preventive control is out to prevent problems from occurring in the first instance. That is, you consider all the arrays or possibilities of problems that could arise from a flow of activity. Then you try to put measures in place to prevent them from ever occurring. What are we saying? For instance, an organization installs car tracker in its, on its cars. Car tracker, so that the drivers of the companies don't just take the cars at random and go and use it for their own personal things. Or they don't even steal the cars, the company cars altogether. So preventive controls, they are out to what? They are out to prevent the problems from occurring in the first instance. They try to prevent the problem from occurring. We have different stuffs, different types of preventive controls. We have approvers. Approvers are set so that approval limits, for instance, approval limits are put in place so that what? So that you don't initiate an action or transaction and be the one to approve it as well. The same thing is authorization. Who authorizes a particular transaction? Is there an authorization limit? Is there an authorization control in place for specific transactions or events? That is, who has the authority to say go ahead with this? We have verification. Who verifies what? Then the most important is the issue of segregation of duty. Segregation of duty is what? Is trying to prevent fraud from happening. For instance, a particular staff is qualifies for official car. I'm using official car as an example as well. So he initiates it that, okay, I'm now on the level where I am entitled to an official car. He is the initiator. His boss or his superior will approve it. I'm talking about segregation of duties under preventive control now. When the boss approves it, it is the account department that will what? That will credit or that will approve the payment to the vendor. But it's not the account department that will determine the type of vehicle that will be bought. As per policy of the organization, there will be a particular level of car or grade of car that matches its level. And it is the duty of what? Of the procurement department to align or to get the right vendor to bring the right car, and the account department pays. You can see all the different departments that are what? That are involved now. Initiation from the person that needs the car or is entitled to the car. Maybe he sends a mail to his direct boss. His direct boss and maybe many chains of bosses up there approves, and what? And the procurement department takes it up to get him a car, and the account department pays. But in a situation where he is the one that initiates it, is the one that what? Gets the types of car he wants, is the one that goes to the market. What if they give him 5 million to buy this car, and he even went to buy something substandard, something not up to half of that price, and he corners the remaining? And mind you, the asset is still belongs to the company. So who suffers? Is the company. So in order to prevent such, the duty is separated. There's segregation of duty. It's a simple thing. You could have said, why not just give him the money, let him go and buy? No, we are trying to prevent fraud. That could be a small, what about when we are talking about ordering? Maybe stock for the whole organization. It's not the duty of the stock manager to place the order. He can request, but he won't be the one to to place it. The store doesn't play. It's the purchasing department. We are trying to separate duties so that the store manager doesn't align or collude with the vendor that supplies, and they start ripping the organization up. You can see how important segregation of duty is under what? Under the preventive control. So we also have the dictative control. Unlike the preventive control that is out to prevent the fraud from happening at all, the dictative control's function is to dictate if there has been a fraud. In most cases, it's not like there has been, it's not like necessarily there has been, but who knows? Because like I've said in a previous class, no preventive control or no internal control measure is 100% perfect. None. You can be close to perfection, and the closer you are to perfection, the better for the organization. But none is 100% fraud proof. So the dictative control plays the role of detective, from the word dictative, to dictate. You try to dictate. So you play the role. You go out in search and in bid to dictate if there has been. For instance, now, stock count, random stock count, random stock audit, random cash count. Maybe the petty cashier's desk, you just go, the internal control just go at random, maybe once in a month, twice in a month sometimes, just to go and cash the count and pair it and review it reconcile it with the petty cash book. Is it like you are prevering? Is it like you are taking the part of this money here and there in the stock, in the company store? Does the amount on the system does it match the physical stock count that we make? So if there is now significant difference, unreconcilable difference, then there's a reason to now what? To now say, okay, there is a fraud. What is the fraud? Who perpetrated the fraud? Why and when? Where? All those questions needs to be answered. So things like reconciliation, bank reconciliation statements, reviews, data analysis, e.g. budget versus actual. Why is the actual so different from the budget? We budgeted to spend, for instance, 10 million naira on diesel this year. Why is it 20 million naira? You are trying to dictate. Is it like they are not supplying the right thing? Is it like the people in the purchasing department, they've colluded with the vendor and they are supplying substandard or below the quantity? Or is it like some people are even stealing raw diesel from the tank? Because these are possible stuff. Then benchmark is comparing likes with like. We have a standard. This is the standard. What is the variance? By the time we compared standards with actual, what is the variance? We are benchmarking something with something. Why is the variance? Why? Like in production, what is causing the variance? Is it like they are not putting they are stealing materials and they are now producing substandard outputs? Computer assisted audit techniques. These are things that helps to detect sometimes. We will still see the different techniques in detecting fraud. Different computer assisted techniques where you use softwares, where you use different tools to just detect, even from very big datas that are mammoth, that manually you can never detect fraud, but it will show patterns. It will show you, the tools will show you different alignment of patterns that this is, or it will show you exceptions and anomaly that you'll be able to trace easily and detect where the fraud is coming from. But like I said, no control system is perfect, but you must realize that the closer the preventive measure is, the preventive control is, the closer it is to perfection, the better chances of detecting fraud when they occur. That is, if this preventive control is sound enough, even if there is fraud, it will be easier to detect. But in a situation where the company has gotten the preventive measure wrong, it will be very difficult to detect fraud. For instance, an organization that has CCTV, I've been using this example, CCTV in all the strategic points, and somebody stole a computer that is worth a laptop, maybe a high definition laptop they use for particular stuff, and is a very small one. You can just put it in your pocket and go. And somebody stole it. One of the staff that is not aware that the CCTV are in strategic places. It will be easy, because you put that preventive measure of CCTV. It will now be easy to detect who did what. Who stole the stock? Who stole the assets? Who did what? So the last control, kind of control, is what? Is the corrective control. Corrective control. What is corrective control? Corrective control, after identifying the fraud, after the fraud has been detected, after we've known that, okay, there is a fraud somewhere now, how do we correct it to forestall future what? Future occurrence. So that this is not how to it's neither for prevention nor for detection alone. Is what? Is to provide solutions to problem when they occur. The problem has already occurred. We are not just trying to detect it. We've detected it. This is the problem. So what is the solution? How do we move ahead from here? We have system restoration under corrective measure. We have control changes or addition. Maybe the control has been breached. We see that, okay, we need to put additional authorization, authorization level. Maybe from the system, when I initiate something, or when my subordinate initiates something, another subordinate, his own boss, will approve, and I will now be the one that authorize what has been approved by my own subordinate, making two levels. But we now see that, okay, from the way things are, we need additional authorizations, approval levels and authorization levels. Or maybe we even need to input, after the authorization, somebody needs to still verify. You can see now, these are the preventive we are trying to bring into the corrective after a fraud has been detected. These are control changes. It could be an overhaul of the control system altogether. That is, you want to repattern your control system. Maybe this department communicates with this and this before. Maybe you are now saying communicate directly to the MD. These are control measures. Maybe the matter is so sensitive that you don't want to involve two departments again in the chains of command. You just say, for this particular, what's it called? Sometimes you will see an organization redrawing their organogram, that they will just put out one department, depending on the sensitivity of the situation, and say, we will report directly to the MD. That is control changes or addition or subtraction. Then data validity test. Insurance might be like, okay, we will now want to insure, maybe for theft, for burglary, for this. Variance reports. Making the variance, we said benchmarks here, and I talked about variance. Here, you are now making the report and analyzing why that variance is, so as to work against getting such variance in the future. Or if that variance is now seen as the new normal, maybe the costs of procuring your raw materials are now high, and that is why you have big variance between your budgeted cost of production and the actual. Then the report will say it, and we know that, okay, this is not actual fraud, this is just changes in prices that is causing this. Then corrective measure could be training of staffs and giving them awareness. Maybe a customer duped you, maybe there is this you need to be know your customers very well. Maybe in a bank now, one customer was successfully withdrawn from another customer's account, and the fraudulent customer was nowhere to be found. If you have know your customers, you got the right identity card, you know the house was actually identified, the people close to me were identified, it would have been easier to trace such customers. So for these kind of things, it could be all needed, could be training and staff awareness. Maybe somebody forged a check, for instance, and it wasn't detected. He has already cashed out before it was detected. Maybe the staff needs to be trained about the different fraudulent techniques that customers are using now. We've seen situations where people use fake money to transact. We've seen situations where people say they've transferred funds from their account using USSD code to a particular seller or vendor, and the particular vendor in question, we actually see a credit alert, but it's a formatted text message that is not real. So he was only seeing a wrong or fraudulent message. So if such things occur, the fraud has been detected. Now, how do we correct it? That could just be training of staff, that we don't just rely on seeing text message as credit alert when you are selling. Maybe you are selling electronics now, and your staff just saw what's it called? You have transferred 100,000 or 300,000 naira to you, and you just on the basis of that released the goods. It might be like, go and confirm from the accountant or from the owner of the company, if it's just a one-man business, that have you really seen the credit alert, or has it reflected in your account? So these are things we need to take note when we are talking about the types of internal control. So a good fraud prevention control, apart from preventing fraud from happening, also make easy for detection if it ever happens. Just like we said, preventive control is also the type of control that puts the predator in perspective and consideration more. That is when the predator knows, because this is pre-fraud stage. So when he knows, when the predatory fraudster knows that the preventive controls are very high, he reconsiders again. The mere fact that your preventive controls are very high, they are very solid, makes it doesn't only prevent the fraud, but instill fear in the heart of to-be or potential fraudsters from carrying out. But when they know that everything goes here, the propensity to commit fraud will be higher. Everybody will want to take advantage of the weakness of the control measures. It is also a proactive way of first considering ways fraud could be perpetrated and blocking off such avenues before fraud is attempted. That is, you are being proactive. When you take that preventive measure to a very standard level, you are not being reactive. These other two, they are reactive measures. You are reacting to stuff, especially the corrective measure. You are reacting to what has happened. Detective, you are reacting to, okay, has it happened or not? But preventive is, you are actually being proactive, which is the best, because they said prevention is always better than cure. How does prevention, or how does internal control, how does it connect with internal audits? Because the internal control actually should be the brainchild of the internal audit department. An internal audit is the frequent and ongoing audit conducted by a firm's own accountant for the purpose of 1. Monitoring operating results, 2. Verifying financial records, 3. Evaluating internal controls, assisting with increasing efficiency and effectiveness of operation, 5. Detecting fraud. These are what the internal control is out to do. It is the function of a department, which is actually, that department belongs to the organization. These are employees of the organization. The accountants of the organization, they are the one in the internal control department. They are the internal audit department. So part of their duty is evaluating internal controls. Among other, part of their duty is evaluating is our internal control, the preventive, the detective, the corrective, are they solid enough? Another part is detecting fraud, if there has been fraud. So that aligns with the detective types of the internal control. Then they monitor the operating results. They verify financial records. They assist in increasing efficiency and effectiveness of operation. So internal audit is an important means of identifying control problems and the aim of correcting lapses before they lead or result to fraud. So they identify the control problems and lapses and put things in place before it results into fraud or big losses for the organization, and before they are discovered during external audit. So they do this. They even help the company not to be exposed to wrong audit opinions, which will affect their public perception. By the time your external audit says a lot about you, that the way this company is being run, there could be fraud, there could be this, investors will run away because they know there is no proper control measure. But internal audit will help put this in check before the external audit comes in, so that the external audit will meet a working system, a system that in their opinion, they can say this system is reliable, this system is fraud proof, this system is not just open to any loophole. So the internal auditor are the firm's employee. They understand the process flow of the organizations more as an insider. They understand it and they help install the right internal control. You can see how they connect. They are the insiders that help install the right internal control in order to prevent fraud, in order to prevent operational inefficiencies, in order to make sure that the financial records are at par, in order to assist with increasing efficiency and effectiveness, in order to verify the financial records, in order to monitor results and know that, okay, we are operating at our optimal level. So this is how internal audits aligns with internal control.